Bitcoin's unique because no amount of capital flowing into a Bitcoin ETF is going to create any more Bitcoin. What we've got is 900 Bitcoin a day. And around April 16th to April 18th of this year, we're going to go to 450 Bitcoin a day. This will be the halving, but it will be the single most consequential halving in the history of Bitcoin. It's digital capital. Well, how big is that? $400 trillion?
Saylor opens the discussion by likening the emergence of Bitcoin ETFs to a monumental IPO event, albeit on a much grander scale. He underscores the significance of multiple major financial institutions, including BlackRock, Fidelity, Grayscale, and Bitwise, simultaneously embracing Bitcoin as a tradable commodity. Unlike traditional securities, Bitcoin's classification as a commodity amplifies the impact of these ETF launches, signaling a paradigm shift in investment dynamics. Drawing on his extensive knowledge, Saylor contrasts the characteristics of Bitcoin ETFs with traditional commodity-based ETFs and equity indices like the S&P 500. He highlights inherent flaws in commodity ETFs, noting their susceptibility to price manipulation and oversupply due to the fungibility of physical commodities. In contrast, Bitcoin's scarcity and digital nature position it as a superior investment vehicle, immune to the supply dynamics plaguing traditional assets.
Bitcoin coming public, it's like the IPO of Bitcoin, except it's like 10 companies simultaneously taking Bitcoin public. Because Bitcoin's a commodity, it's not a security. So the idea that BlackRock and Fidelity and Grayscale and Bitwise and ARK, they're all taking Bitcoin public at the same time is a big deal. The fact that I'm not surprised they're successful as ETFs because Bitcoin's the apex ETF. The other ETFs are based on oil, like let's say commodity ones, oil, gold, platinum, silver, palladium, market baskets of commodities, natural gas. All of these things are defective as investment assets because physical commodities aren't scarce. Physical commodities can be manufactured in any amount with additional capital and know-how. So ultimately, the best of them is the gold ETF. But if a bunch of money flows into a commodity ETF, that just actually fuels capital into commodity producers. They just dump that commodity on the market, the price gets held down. So commodity ETFs were never that great an idea. On the other hand, comparing these Bitcoin ETFs to the S&P index, the biggest ETF and maybe the biggest development on Wall Street was the launch of the SPDR, SPY, in 1993, about 30 years ago. And the idea that you could create an ETF that represented a market basket of 500 stocks, that was big. And especially that was big because that came along at a point where people had lost faith in the currency as money, as a savings technology. And so they were trying to figure out what is money. And actually an entire generation of people picked the S&P index as money, right? How are you going to store your excess cash for a decade or longer? Not a checking account, not a savings account, not a bond, but the S&P. So the S&P became money, and that ETF became the monetary index. And that's why today, amongst, that's the most successful ETF. If you look at SPY and all the S&P index type ETFs, they have most of the capital in them. But the problem with those ETFs is that stocks also are not conservative. So if I increase the price of the stock by a factor of 10, you're getting more equity. Or if another way to say it is, if I take hundreds of billions of dollars of cash and I buy the ETF, like S&P ETF, the ETF has to buy all 500 stocks pro rata, which means they're going to have to go buy Tesla and Apple and Google and Meta at any price. They're price insensitive, even if they're overpaying. So when they buy it at any price, what they're doing is they're creating more equity because they're encouraging those companies to issue more stock. And then, of course, this is common sense. If the price of your stock doubles, the employees in the company with stock options, they sell the stock, right? They sell the stock option. When they sell the stock option, you put more stock on the market. So the price creates supply. There's a price supply elasticity there. And that's the same as you have with commodities. It's the same as you have with REITs, real estate investment trusts. And it's the same thing with bond funds. When you have capital flows into all those other asset classes, you create supply of that asset. They're not scarce. Bitcoin's unique because no amount of capital flowing into a Bitcoin ETF is going to create any more Bitcoin. What we've got is 900 Bitcoin a day. And around April 16th to April 18th of this year, we're going to go to 450 Bitcoin a day. This will be the halving, but it will be the single most consequential halving in the history of Bitcoin, because you're talking about, it's the equivalent of someone coming in the market saying, I'm going to buy $8.5 billion of Bitcoin a year for the next 4 years, guaranteed. That's the demand impact, right? $8.5 billion, $23 million a day at the current price. Now, that's a huge amount, but more importantly, that's a huge demand-supply shift in the year when the demand via the ETFs has jumped by a factor of 4 to 10 times the daily supply. So what you have is institutional capital entering, and then you have the supply getting cut in half. And, what happened with these ETFs? Well, here's what happened. The approval of the ETFs was a pretty concrete endorsement of Bitcoin as an asset class by the regulators. And anybody who's thinking about banning Bitcoin or not approving Bitcoin ETFs, they're now out of consensus. So it really flipped the global consensus from, well, maybe it's too good to be true, maybe it'll be banned, maybe it won't be banned. The approval of those ETFs meant that it doesn't matter who wins the 24 elections. It's taken the future of Bitcoin out of the hands of the president. It's taken it out of the hands of the next head of the SEC. It's taken it out of the hands of most regulators in the world. We pretty much opened Pandora's box or crossed the Rubicon. It's very concrete at this point. And it was uncertain, right, before. And so that's a very big piece of regulatory clarity.
Saylor delves into the upcoming Bitcoin halving event, slated to significantly reduce the daily supply of new Bitcoins. He emphasizes the unprecedented demand-supply dynamics triggered by institutional capital inflows coinciding with the halving. This convergence of factors is poised to exert substantial upward pressure on Bitcoin prices, reinforcing its status as a coveted digital asset with unparalleled scarcity. The approval of Bitcoin ETFs by regulatory authorities represents a pivotal milestone in the mainstream acceptance of cryptocurrencies. Saylor asserts that this regulatory endorsement solidifies Bitcoin's status as a legitimate asset class, transcending geopolitical uncertainties and regulatory ambiguities. The widespread approval of ETFs underscores a global consensus on Bitcoin's role in the future of finance, fostering a positive regulatory environment conducive to further innovation and adoption.
What happened next is it's created a positive dynamic where now I think you're seeing pressure to approve ETFs in other places in Asia. You'll probably see Hong Kong spot ETFs. You'll probably see them get approved in any country where people are on the fence. It also created a fee war. It used to be that you paid 2.5%, to hold your money in grayscale. And all of a sudden now you're paying 1.5% at grayscale, but you're paying 25 basis points at BlackRock, or you're paying 20 basis points and even 19 basis points. Not only did that bring down fees for institutional holders of Bitcoin in the US, it also put pressure on international fees. So you actually saw a rippling effect, and people with European or Canadian or other spot ETFs in the rest of the world that had 100 basis point fees or 150 basis point fees, they're having to bring down their fees because otherwise the capital will flow out of their instrument into the lower cost instruments. So, yeah, let me convert the math here. If you have an infinite duration asset and you're going to put, if you're going to put money in it, then the difference between 2% fees and 25 basis point fee is losing 37% of your money. You understand? Like it's like I take a third of your money. Okay. So if you're a Bitcoin investor, you know, having low fees means you invest $1 million and you get to keep the $1 million. Having high fees mean you invest $1 million and you lose 300,000 of it over the course of 20 years. So those low fees are, well, where is that going to manifest itself? It's going to drive the price of the asset up, right? First of all, because the people that own the asset aren't losing 1 or 2% of their money every year. But second, because there are a lot of people that they will either invest $1 million in it or nothing, right? So if I like it, I'll just invest $1 million. If I don't like it, I'll invest nothing. So you start to see money flowing from gold into Bitcoin, from real estate into Bitcoin, from the S&P index into Bitcoin. And so that's a big deal. So the launch of the ETFs, it's been very successful. This is the ideal type of asset to put into an ETF wrapper. It's definitely it's the global asset. It's the biggest brand. Everybody knows what it is. It's actually the best thermodynamically sound investment. It's got the best historic performance. And of course, it doesn't have the entire array of risk factors that a company has or that a bond has. It doesn't have credit risk. It doesn't have corporate execution risk, you know, and it doesn't have currency devaluation risk. And it doesn't have the physical risks of real estate. It's not going to ever get hit by a bolt of lightning. There's not going to be a tornado. It doesn't have maintenance decay. It doesn't have property tax risk. It doesn't have the political risk. I think, you know, as I'd said, the real key is to understand what is Bitcoin's use case. It's digital capital. Well, how big is that? $400 trillion?
Saylor sheds light on the fee dynamics sparked by the launch of Bitcoin ETFs, triggering a competitive race to lower expense ratios among ETF providers. The subsequent fee reductions not only benefit institutional investors in the US, but also exert downward pressure on international fees, fostering a more cost-effective investment landscape. Low fees are instrumental in attracting capital from traditional assets like gold, real estate, and equity indices into Bitcoin, underscoring its growing appeal as a superior store of value. In concluding his analysis, Saylor reiterates Bitcoin's unparalleled value proposition as a thermodynamically sound, risk-averse investment. He emphasizes Bitcoin's resilience to traditional risk factors such as credit risk, corporate execution risk, and currency devaluation, positioning it as a compelling alternative to traditional assets. With a market capitalization potentially exceeding $400 trillion, Bitcoin's digital capital represents a transformative force in reshaping the global financial landscape. Please like and subscribe my channel.